Hello everybody and welcome back to another True Potential Do More With Your Money podcast. It's episode 185 this week. If you watched last week's episode, you'd know we talked about goal setting and the importance of having a goal. And one of the most common goals that people set and that we talk about is setting up the next generation, how best to save for children, grandchildren, that sort of thing. So we're going to be talking about that today on this very podcast with Jeff to my left-hand side, and across the table we've got Hannah, and making a podcast debut, it's Greg on the podcast this week. Hi Greg.
How you doing? How are you, all right?
Very good. Welcome to the True Potential podcast. You excited to be joining us today?
I certainly am, yeah. But I've been promised a True Potential gilet, so that's
yes.
a bit of a benefit for me.
And make sure you get a mug as well, a gilet and a mug. Everyone goes home happy. Tell us a bit about yourself then. So for our audience who don't know you, never seen you on the podcast before, tell us a bit about you and where you work and what you do. And well, we know what you do, you're an advisor, but tell us a bit more about you.
Yeah, so I've been with True Potential for 10 years.
Yeah.
I'm based in Bristol, and I love the job really. I love the company, the culture. I brought 5 clients up here yesterday, and the way they the smiles on their faces when they left, the sort of confidence they've got in the proposition was really good actually, yeah.
And you say you love your job, what's the best thing about it?
I think it's basically helping people, educating people, in terms of getting to where they want to get.
Yeah.
I think a lot of people can just go through life without having goals in place.
Yeah.
And what we can do obviously is just look at their unperceived needs, bring it to their attention, and give them the tools, if you like, to meet them and work towards them.
Brilliant. And have you ever spoken to 10 million people before?
No, I haven't done that yet.
Well, neither have any of us, but today could be that day. You never know. You never know. Yes, so as I said before, we want to talk about how best to save for children. Because, I mean, we've all got children around this table, and it is one of the most common things you think about is, well, what's the best way to put a bit of money aside for the family and for later on? And I guess, I've been guilty of this in the past, like most people, I imagine. You sort of just think, well, I'll set up a bank account and put a bit of money in the bank account, which, good to have got started, but might not be, for a lot of people, might not be the most or the best way to do that. There are other options you might want to consider, and I'm sure these are the kind of conversations that you and Hannah, you probably have with your clients as well. But let's just talk about, first of all, maybe what are some of the options that would be on the table? What are some of the common ways? I'll come to you first, Hannah. What are some of the most commonplace ways that people do save for their children?
Yeah, well, like you say, if it's not a bank account in their own name or in their own name somehow, there's junior ISAs and also junior pensions as well. They can also have child trust funds set up from when they were born as well. And
do you have a particular preference? I mean, are you do you veer towards one, or is it a question of a bit of everything? What's your own personal sort of strategy?
Well, I don't have any children, but
well, I got that wrong with that at the start.
But if I did, well, a bit of both, because they both have excellent qualities depending on what you're looking for. Especially junior pension. A child, whether a child or a teenager, they're not going to be thinking about a pension. The first thing they might want to save for would be perhaps a car or a house. So perhaps a junior ISA would be more appropriate for that, if not their own saving by that time. But a pension, I think, is something that a parent could really help and start building a sizable pension pot for when they do reach that age. Yeah.
I should have known you don't have children. You don't look knackered. I'm not saying you do. I'm not saying you two do. But you can always tell. What about yourself then? I mean, you said you've got a young lad. You've got another one on the way coming soon.
Yes.
Well, congratulations with that.
Thank you very much.
Yeah. What's been your approach so far?
Well, I'm quite passionate about it. I do both for my son. My son's 10 years old now, and I've got a junior ISA and a junior pension.
Right.
I think it's important saving for them, but for me the main benefit is the education. Is giving them a product, and I have a bit of a banter with my son, if you like, about your money's dropped in value, but it's a great time because obviously you put more money in, and just teaching them about how the markets work. So I think when they do get a bit older and they have to take it themselves, they've got that education and confidence that if it does drop, not to panic. It's long term. But I think.
And what's your son's name?
Son's name's Riley Shelton.
Have a look down camera 2 and give him a wave. I've always seen people on TV
Riley.
do this, and I've always thought...
Definitely, no, thanks. But
and is it something you talk... I mean, he's only 10 years old, but is it something that you talk about?
Definitely, yeah. I'm always telling him that his money's going up and down, and sometimes he's cross, sometimes he's obviously very happy. But it's about compounding. I tell him about, obviously, the earlier you start, the earlier, obviously, you'll get to where you want to be. And having a goal in mind. I mean, he's obviously very young. Having a goal is not really applicable at this stage, but he will want obviously to buy a house when he's older.
Sure.
And like you've alluded to, there's different products which is going to be accessible at 18.
Yeah.
And the pension for me is it's a more of a long-term one that you won't be able to access. But it's a great way of getting money out of my estate and helping you out.
Well, and Greg just mentioned there about compounding, Jeff, so great time to bring you in from the investment side of things. I mean, just maybe for people who are new to the podcast, obviously a lot of new people coming to watch this each week and get some knowledge of their finances and what they could do. What is compounding and why is it so important?
It's ultimately just the role of money growing on money, and the expectation of the interest that you earn and that compounding effect of interest each year coming through, and it's exceptionally powerful. And over the long term, we know that compounding is the key aspect of long-term investing. Yeah. That's that drives the real difference between that person that potentially ends up with a £50,000 pot and that person with £100,000. It's about when you start and just that rate that you can compound up.
Yeah. And would it be realistic or not to say that if you started, say, with putting £1,000 in today, and by the time say a 10-year-old today reaches pensionable age, that pot's going to have grown, hopefully significantly. Yeah. Would it be correct that the compounding has done most of the work versus the contributions, or is it fairly evenly split? Or what are some of the factors involved in that?
I suppose there's a couple of factors that are going to be really quite important in that. It's the term. So when you start, and that's why I think for the topic today, the children's side of things, it's so important. The earlier you start, the more you benefit from that longer term compounding nature. Yeah. And over that longer term period, it will be the compounding that is driving the large part of that appreciation that you're seeing. The other factor that you need to take a view on, I suppose, is what you might think of market growth is going to be in that period, what inflation is going to be. Those all come together to influence that longer term outcome. But for me, it's definitely the compounding aspect that brings the difference for individuals.
Sure. And to ask the same question, in terms of your own, preferences. I mean, is a pension something you've opened for the family, or were you more of an ISA man?
For the boys, they've got a bank account and they've got the junior ISA. Yeah. And I kind of leave the ISA to the side, and that's something just to educate them about, and it's there. The bank account, I think, gives them the ability to set shorter term goals and to see how they're achieving that. So if they're saving for, I don't know, new PlayStation game or whatever, you can put a little bit in each month, and then you'll get there over time. Yeah. And it just sets that goal and allows them to see how they achieve it.
It's interesting because mine are both under 10, but we've just, they've got their own. You can get these little sort of effectively debit cards now that they can have their pocket money put onto, and just that thing about going to the supermarket and can I buy that little toy or can I buy that? Well, yes, you can, but you go and tap the machine, and when you get in, and you can go on the phone and see that your pocket money's just now gone down, and if you want to have that next thing, you don't have enough in your account, but next week's pocket money, or do a few things around the house, and you can afford that next week. So just getting that little thing about small amounts in and out, and do you really need that? Well, why don't you save a bit more, and next week you're gonna have even more again. You'll get something bigger if you wanted to, or two of the things you want, or whatever it might be. So it's fascinating, isn't it? Watch their little minds work about getting them to understand
definitely
money and stuff. On the junior ISAs then. So Hannah, just come to you. So tell us about some of the rules around junior ISAs and how they differ from, say, a pension. I mean, we talked about. I remember being on the podcast a few months ago when we first talked about the idea of opening up a pension for your child. And it's just something I'd never considered. I'm sure you all have probably had conversations with clients, but I'd never considered it. So we'll talk about that in a sec. But for now, what are the junior ISA rules in terms of how much you can put in per year, who can put in, when it can be accessed, all that stuff?
Mm-hmm. Yeah. So a junior ISA can be opened for a child from 0 up to 17, and it would be opened up by a parent or a legal guardian, so they would be in charge of it, of the policy, but very much be in the junior's name, and it can have up to 9,000 invested in each tax year, and then once they turn 16, the child is able to sort of take over the account, and then by 18 it moves into an adult ISA in their name.
Okay. And that's 9,000 for the ISA, so if several people are paying in?
So several people can pay in. It doesn't need to be the parent or legal guardian. It could be grandparents, aunties, uncles. They can contribute
bit of birthday money, that sort of thing.
Yeah, exactly. And it doesn't need to be one-off payment. It could be regular payments, like you say, the pound cost averaging on a regular basis. So it's quite flexible in terms of how it can be contributed into.
Yeah. And what's the process of that transitioning into an adult ISA? Because typically, you then sort of pay some, maybe at 18 the child gets a job or whatever, and then is it a simple transition across to? Are there any rule changes then? Does it then become the £20,000
Yes.
annual limit? Is that seamless or?
Yeah, exactly. So it's an automatic process. You know,
Yeah.
we've got the dates of births on file. So as soon as they hit 18, it moves into an adult ISA, and then the adult ISA rules apply. So the 20,000.
Right.
limit.
Okay. Great. Okay. And then contrast that with the pension then. So that as I say, we talked about this on a podcast a few months ago, and you mentioned it as well, Greg, as well. So what are the rules around effectively a junior pension? How does that work?
Right, so junior pension, again, you can contribute into that from zero. In terms of the annual allowance, it's 2,880,
Okay.
and that's the net contribution.
Yes.
But it gets grossed up. So if you
The
put-
tax relief element on the
correct, yeah.
contributions going in.
So for the child, you would contribute as a parent, grandparent. You can collectively do 2,880 in total,
Yeah.
but it's 3,600 will hit the pot.
Yes.
So I think it's a monthly amount of 240 going to the pension. That would be the monthly contribution that would obviously equate to the 2,880. But it's a great discipline, and it's what I quite like about it as well is if you've got an inheritance tax problem, for example, any money you fund into the pension is not liable for inheritance tax because it's gifted out of income.
Yes.
So that's quite a salient benefit for parents, but also for grandparents as well.
Yeah. And do many people talk to you about this? Are people aware that they can open a pension for their kids?
I wouldn't say not many people, no.
Yeah.
So I think this is good to sort of spread the word, definitely. And yeah, because I know an email did go out last week, was it, or earlier on in the week? So yeah, I'm hoping that's something that's going to be talked about a lot more, and for myself as well. It's a good talking point for clients with children.
Yeah.
Yeah, it's definitely an unperceived need. And I think, one of the things with this is that the pensions can't be accessed until the child's 57 currently, and that probably will go up in time, I would assume. And the ISA they can't access until they're 18. So it isn't very liquid money, which can be an advantage, because obviously sometimes it is easy to dip into pots. And another consideration for the junior ISA as well is that if you're saving up quite a lot of money into that, it is going to be absolutely theirs at 18. So you've got to be a bit careful with that as well, because sometimes children at 18, it's not always the best time to get a lot of money.
Well, it depends who you ask. I mean, if I'm sure for the 18-year-old, it's a great time to get money.
Very true.
And so Jeff, then thinking about those ISA, actually, by the way, on the ISA, you said 9,000 allowance for the pension. It's 2 and a bit, but then grossed up to 3. Why the difference? Why is one much more, if you like, generous in terms of the allowance on the way in than the other? What would be the reason for that?
So, I mean, for the pension, that is the limit for if you don't have an income coming in. So it would be a bit unfair to give children a much higher allowance for the pensions than compare to what adults get. So it's kind of a flat sort of, you don't have an income coming in, that's the most that you can put in.
Okay, all right. And when money is put into pensions and the junior ISA, then Jeff, again, for people who perhaps are new to this world of investing and or maybe thinking, well, do you know what, I was going to open a high street bank account for my child, but I'm interested now in these pension and ISA. When the money's invested, obviously your team and your colleagues from the investment management teams will look after this. What's happening to that money? Where's it going?
Well, I suppose this is the beauty of the model that we have in terms of anybody can save in. It could be in the junior ISA, it could be through impulse save, it could be as low as £1 that's coming in. But when that money comes in through the door, if you will, or through the pipe, it then comes through and is allocated out to the different managers with whom we're working, and that depends on the risk profile. So it might be going to UBS, it might be Goldman Sachs, it might be Allianz, etc. And that is a seamless part of the technology, and the integrated nature of the technology in the background comes in, allocated out. So it goes to the manager, but when it goes to that manager, it'll be allocated into equities globally, not just into the UK, but also into bonds. And we think about that, sovereign bonds, corporate bonds as well, and alternative instruments. So we'll have some gold and we'll have some commodity exposure as well. So a real breadth of opportunity that comes from that, the scale of the business that we have and the relationships that we have with those fund managers, and really how that then works for the individuals, in that it's not reliant on one particular part of the economy doing well. What we're wanting to have is a solution that's able to navigate for the longer term, and that's exactly what we're there for. If we think about the junior ISA, the junior pension as well, it's that long-term part of compounding.
I'm loving this idea. There's going to be in a few years' time we have a load of 5-year-olds who, instead of watching Bluey, are going to be watching like Bloomberg
Yeah,
on their tablet, you know, wondering how their markets are good, the stocks are getting on. Brilliant, otherwise. I want to ask about child trust funds, because this is another thing that would be part of a conversation you might have in your family with your advisor.
Yeah.
Explain those. Why might someone want to consider those, and how can they integrate with this bigger conversation we're talking around saving and pensions and ISAs? What's the story with those?
There was a time, obviously, when trust funds were introduced for children when they were born, and I think they were given $250 by the government. But the products that were introduced were quite highly charged, from my experience in the field, and they were very basic investments. Sometimes just one option. So what I sort of tend to advise clients to do is they can transfer them into the junior ISA. And then they've got the much more flexibility, much more lower cost, and like any investment, the most important thing I think is having control. Being able to see it, own it. With the trust funds, you tend to get just a statement once a year, and that's the most you get from them. So you've got no ownership. You don't it's not easy to put money into it. It's a bit of a faff in terms of setting up direct debits, doing that sort of thing. They tend to be sort of building societies and older companies, really, that offer them.
So that much more accessible in terms of transferring into an ISA, in terms of being able to then access. I mean, it's a great opportunity, because you've introduced it there around the technology, and we're talking as if this is very easy, but actually it is very easy to do some of this stuff, to transfer things in, the accessibility, then see how it's doing versus the once a year statement. I mean, is this something that your clients also, when you're talking to clients and perhaps they've not maybe they've been with a traditional sort of building society or bank where it's paper statements, are they sort of impressed by all this?
It's quite common. Most of the junior ISAs that I do open up are a child trust fund transfer over, and for exactly the points that Greg explained there, it gives them a lot more control of where the funds are invested and monitoring, and it's what they're used to as well with the adults with their investments. So it's quite a popular option.
And if you log into, so let's think, mum and dad opens up junior ISA for their son or daughter. They log into their own account on their app and they can see their own pension. Maybe they've got their own ISA. The junior ISA just sits there as well, so they can just see it all in one place.
Exactly,
Wonderful, even better.
And I suppose the other thing there is, if you do have a child trust fund that you may have forgotten about because it was one of those things, if you maybe got 250 from the government at the time, go and have a look. And if you do have it, think about how you can transfer it across as well to get that visibility.
Another point, sorry, Jeff, that you mentioned a second ago. Obviously, we can do it from as low as £1 contribution, but obviously we're in difficult financial times currently, and obviously parents are under a lot of pressure to sort of pay the bills, and this might not be their first thing on their mind. But what I would suggest they do anyway is set up a very small contribution. So the products are there, even if it's sort of £5 a month, £10 a month. Just get the product set up, get the money going out, and then obviously when you're in better times, or you can afford it more, or you get the ad hoc presents and gifts, you can then obviously contribute. But it's not about, sometimes you want this goal to give them this amount of money, but it doesn't have to be set up from day one to achieve that. You can increase the contributions and get there in the end.
Well, like I said, you've made me think, because going back to what I was saying about pocket money and those little debit cards, I'm going to split that now, put some into a few quid each week into their junior ISA, and they can have the rest to go and waste on bottles of Prime and things like that. Right. We mentioned about in terms of pensions and the rules about going in, but then there are also in terms of beneficiaries and how these things are then passed on later. So again, what are some of the rules around, you mentioned inheritance tax before, what are some of the rules around these pensions later and beneficiaries being outside of people's estate? Is that the same for a junior pension as well, or?
Yeah, exactly. So it's exactly the same, but it's until they reach the age of 18, it's going to be under their parent or legal guardian's name, and yet still nominate a beneficiary, have an up-to-date will, and then whoever's on your expression of wish, they will then benefit from the funds. And same for the ISA, junior ISA as well, or any ISAs really. Have an up-to-date will that'll name your executors, and then they distribute the estate. So have an up-to-date will, an expression of wish form. And
then just thinking about your own adult pension as well, making sure that transfers down to the right people. It's important to have those beneficiaries named there, isn't it, as well? Again, something you can do through the app?
Yeah, you can do it through the app. You can nominate anyone as long as it all adds up to 100%. So children, adults, whoever it may be.
And thinking about some of the ways you could do that then, so typically you might think, well, I'll just nominate my other half. But there's a value in, like you said about the percentages, having children nominated on your pension. Is that right? That's a good thing to do? What would be the advantage of doing that?
There's actually a button on our client website, which is you you can add notes. So you look right. Obviously, it has to add up to 100%, but you might want to say, if, for example, my wife isn't around or my husband isn't around, then I want my children to be the beneficiaries. The trustees of the scheme, True Potential, will obviously look at the will. They'll look at obviously potential beneficiaries and make a decision on that. But if you can give them any guidance within the website on your wishes, it helps when we make decisions.
Because presumably without the sort of children listed on there as well, there's then got to be conversations and and more sort of administration
at
has to go on around
time
that
as well.
Yeah. Whereas it just would be sorted if they're listed. Okay, good tip. Just want to sort of take it a bit forward now and talk about how the sort of conversations we touched on it before with you, Greg, about having the kind of conversations you have with children around money.
Yeah.
I mean, is this stuff that you do, Jeff, as well? I mean, in your line of work, I imagine they must, when they ask what Daddy does for a day job, it must be a fairly common thing around your dinner table about money and markets and investing. But I mean, how tell us a bit about it.
It's not as common as maybe you might think.
I bet when you walk in the front door and they say, "Daddy, how the market?" I bet you just think, not now. Where's the lasagna?
Morning markets in the podcast. There you go. No, we do have some of those types of discussions around markets, how they're performing, because I think it's an educational thing.
Yes,
and it's a much broader. Yes, there's markets as equities, bonds, credit, what they're doing, but actually, it's much more about sort of the economy, and it's those types of conversations that allow you to then get in and discuss markets. And I see that very much as sort of an education piece. And what I say education because actually there's very little education given to kids around financial markets. Yes, they get economics and things like that, but it's what does that actually mean for wealth as a nation? How does that translate down into individuals and what individuals need to do? So I kind of think about it as a maths type thing, as an education thing, to try and just help them understand what's happening. But no, we're not talking about valuations at the dinner table. I can guarantee that's not the case
yet. Why is this stuff not taught in school, Hannah?
I don't know. I guess there's other things that children do need to be taught and think about, but actually later on in life it is so important that they do get that basic knowledge. So
it is mad, isn't it? We send kids out into the world at 18, go off to university or whatever, and you're going to need a bank account. There's a thing called a debit card, or now Apple Pay or whatever it might be, and and no real education's ever gone on before that, apart from what we do as parents or as families. But I mean, there's nothing more substantial than that, really, is there?
I think these products, I mean, Junior ISA, Junior Pension, and Savings Account is the difference between them sort of starting out at 25, 30 and thinking about it, or at 20 they're hitting the ground running, and that's the difference for me. And if you look at the figures in terms of what the compounding effect has over a 30-year saving versus a 50-year, it can be 3 times as much. The actual end pot is substantial, life-changing.
Yeah, absolutely. Well, I mean,
I think the other thing there as well is that people go out into the world and they'll borrow, but trying to understand what the effect of the interest rate and the borrowing means, and what sort of lump sum you may want to put into a house purchase to work out the mortgage and things like that. There's so much of that that is really crucially important to get right at the outset.
Definitely,
but to have develop that understanding as when kids are younger, I think is crucial. And some of it's taught in maths, compounding's there in maths, but they maybe link the two things together. That this can have an impact. Interest rates are there, but they're crucially important to understand the power of compounding from the perspective of income growth, but what it might also do from a debt in terms of the interest rate that's sitting on top of it. So if you need those concepts to be able to think, well, is that actually the right thing for me at this point in time?
Well, I mean, we said before it's not taught in schools. Actually, it's going to be, because we're putting this right here. So I mean, it's a brand new initiative that we've got here at True Potential. We're calling it the On the Money campaign, but there are now well over 100 of our advisors who are right now, literally as of today, going out into schools across the entire country and teaching. We've had some as people may know if they've watched these podcasts before or had a little look around our website. We've got a long-standing relationship with the Open University, which goes back 10 years, something which Sir David Harrison, our founder, set up with the OU. And they've produced all sorts of courses for adults, but they've adapted those courses and the content specifically for 15, 16-year-olds for this campaign we're doing right now, and lesson plans and all sorts and exercises for students to do. So we're hopeful that probably just in this first round, over 30,000 students across the UK are going to get some financial education through this round one. We'll expand that and go again throughout the term. But that's all the things you're talking about. So it's, what is savings versus investing? What's good debt versus bad debt? Some examples of that. What does it mean to have, what is income tax and why do you pay that? What does it go towards? And just getting people understanding at that young age of sort of 15, 16 about the things we're talking about. So we're really proud of that here, and I think it's going to make a big difference because, as you say, it's not something which is typically taught too much. There's a bit of it. It happens sporadically, and if you talk to people in one school and then 100 miles down the road, the difference is quite vast. So I'm hopeful we're going to put that out. So I'm really pleased about that.
Yeah, that's good.
So more of that to come, but we're trying our best. I wanted to come to you, Hannah, because am I right in thinking you did the Great North Run last week?
I did, yes.
Right.
Last minute. Very last minute.
Right. That was what led to that then? Why was that a last minute?
I never wanted to do it. I said it's too long. I can't do it. I'll never do it. And then my friend got COVID, fortunately, so she wasn't able to do it. So something in my head was like, Hannah, don't do it. Hannah, don't do it. I was like, I'm going to do it. So then I did it, and I absolutely loved it. It was so good. Yeah, really good day. So if you haven't ever done it and you fancy it, just go for it.
And because it was red hot when it started, and then it was absolutely tipping it down by the end.
Yeah. So I was in the pub by then, so it wasn't too bad.
So you must have had a good time then.
Yeah, I timed it perfectly.
Well done. And I know there was a lot of people who did the Great North Run at True Potential. We've done it people have done it for a long time, but as a collective, if you like, effort across the company raising money for the Sunshine Fund. It's something we've done now for I think 5 years, raising a lot of money for a great cause. And so well done to everybody who did it. If you have a look at our Facebook page, Instagram, you'll see some great photos on there of not just people who did the run, but also then the team from the Sunshine Fund who came in, and you can see some of the people who benefit directly from those great efforts and the donations as well. So it's good. Investing, is it a marathon or is it a sprint, Jeff?
It's definitely a marathon. It's a long journey, but that's what again, that it goes to where we started the conversation. Investing for the long term is really how one should approach it because of the volatility, and that's certainly what we saw through the month of August. Quite a volatile backdrop for asset markets, and to an extent that has continued over recent weeks as we've moved into September as well. So certainly focusing in on the longer term, but there are a number of those points that we've discussed many times recently are really at the fore at the moment in terms of, are we at peak interest rates? A very interesting decision today for the ECB, but also for Bank of England in the coming weeks. Also, we're sort of got this challenge where we've seen inflation sort of tick up a little bit again at the headline level, driven by probably something that we're all really familiar with, just the change in energy prices over recent months, where oil prices up some 24% from its low in June, and that certainly fed into US inflation data yesterday. So the themes that we've been discussing are still very pertinent and relevant, but also starting with our managers to see different opportunities potentially in different regions, just as we are probably in a period where we've moved from an economic cycle that's been very linked together to one that's maybe not as synchronized across the globe, and with multi-asset, different assets, different regions, it should play into those themes as well.
Excellent. Okay, good. Right, we talked about a lot today: pensions, ISAs, beneficiaries, and compounding. One tip from each of you to our audience then, who's maybe watching this and thinking, well, I'm in, maybe as I say at the start, thinking I'm going to put some money into the bank, but you've opened my eyes. We've talked about a few different things here. One last bit of one tip you'd give to people watching this right now who are thinking about how best to save up for their children. What would it be? For
me, it would be start as early as you can, and it doesn't have to be very much. Just get into the habit of doing it.
Just get going.
Yep.
Hannah?
Yeah, I think like what Jeff said as well, but also the fact that you can have it all in one place on the with True Potential, so consolidate it all into one, just makes it a bit easier. So open it, you know it's there, you're going to see it every time you log in as well, so hopefully that prompts to remember that it is there.
Yeah, I think it's engagement, just chatting to them really about why you're doing it, what the long-term goals are for them, and just trying to explain to them and be consistent with it. Just it's obviously children, but just keep engaging with them, keep telling them about the market conditions, make sometimes a negative a positive. For example, if the markets have fallen, say to them that this is a great opportunity, because now you're putting your money in and you're going to get more for your money in the future.
Yeah.
And then hopefully when they're older, they'll remember that, and it will be a learned behaviour, and they'll be a lot better off than I was when they start.
Brilliant. And I'd add to that, speak to your advisor. You know, if you don't have one, give us a call. And if you do have one, you know, these are the kind of conversations that you might want to have. So it's always worth doing. Right. Okay. Thanks very much, Jeff, Hannah, and Greg for now. Thanks very much for watching, and we'll see you next time. Bye for now.